from HUL to ITC, that's managed to earn more than half of its revenues from non-tobacco businesses for the first time ever. Agam's here to take us through the details. Agam, that's quite a feat, but why are we talking about it today?
Sure, we're talking about it because we want to go through the key takeaways from the annual report. And this is, of course, the biggest highlight here, considering the gross revenues and the contribution of cigarettes on the gross revenues have fallen below the 50% mark for the first time, which means that FMCG, along with agri, paperboards and hotels business, has taken over in terms of revenues. So this is how you're seeing your contribution of cigarettes to non-cigarettes business pan out. And over the last few years, as you can see, it's usually been around about the mark of 60% for the cigarettes business, and that has now fallen below the mark of 50% to currently at 46%, with the revenues of non-cigarettes coming in being higher. Don't forget, this is on the gross revenues number. What we're also looking at is, for the first time in 5 years, there has been an improvement in not only the return on capital employed, but also return on equity, and that perhaps is a positive for real ITC. So while we have seen a little bit of a drop, as you can see here, for return on capital and return on equity, both these numbers are better off as compared to what we've seen last year in ITC. So these are the two big takeaways for ITC, and that's the reason why a lot of analysts are positive. They're putting up higher price targets on ITC. Now, in terms of some of the other takeaways, free cash flows have come off. We're seeing a decline of around 7% on your free cash flows. So that of course is a problem because of extended working capital cycles, and that's because receivables have been taking a little more time. But let's move on and talk about your cigarettes business, and we've seen an increase of around 6% volumes, and this is of course an estimate because the company doesn't report volumes growth, but this is according to CLSA. The new variants have aided growth, especially in the classics portfolio and the Gold Flake portfolio. And we did see a little bit of a dip in EBIT margins. On the whole, there has been growth, and this is given that we didn't really see too much change in the taxation regime or the cess. The FMCG business has seen an 18% in growth, and the key drivers here are Yippee and Ashirwad Atta, two brands that stand out here, and they have been doing very well. Of course, when it comes to ITC's FMCG vertical, that is in terms of others, we have seen a scale up in juices, chocolates, coffee and dairy as well. And in terms of your other factors, we're also keeping an eye on your hotels business, where your average room rate has also seen higher occupancy. And coming down to your agri business, or rather paper business, it has seen a little bit of recovery, and your agri business, while it has seen growth, there has been a lackluster movement as far as your exports are concerned. But on the whole, it's been a fairly important year for ITC, given the fact that it's become consistently profitable in its FMCG, excluding cigarettes business. And we've seen an improvement in return ratios, and that perhaps is a big takeaway from the annual report this time around.
Thanks, Agam.